Hello, I've returned today with another ADH Wealth solution. Today, we'll begin to discuss fulfilling all of your financial needs. In this video, we'll review an article discussing the changes in capital gains tax with the Biden tax plan. As always, this is a basic description. For an evaluation of your own, please schedule an appointment. My information is in the description box. Lastly, make sure you hit the like, and if you're new, hit the subscribe, drop a comment, and hit that notification bell so you can be made aware every time I release new content. Everything you need to know about Biden's capital gains tax plan. A May 21st, 2021 article by Roger Walner from Think Advisor. President Joe Biden's American Families Plan includes some significant overall tax increases to fund its costs. A key part of his tax plan includes substantial increases in the capital gains tax rate for some taxpayers. Here's a rundown of what could change as far as capital gains and what this could mean for you and your clients. Capital gains tax basics. Capital gains taxes are assessed on assets that are sold at a profit. While this is often associated with stocks, it can also apply to the sale of real estate, a business, and other types of assets. Capital gains taxes are applied only to the realized gains from the sale of an asset. Gains are the price received for the asset less your cost basis. Your cost basis includes not only the value of the asset when acquired, but also any costs to acquire the asset, such as commissions to purchase shares of a stock. There are preferential tax rates for long-term capital gains taxes. These are realized gains for assets held for at least 1 year. The current long-term capital gains tax rates are 15, 20, or 23.8% for higher income taxpayers. Assets other than stocks may have different rates for capital gains taxes. Short-term capital gains on stocks are taxed at the taxpayer's ordinary income tax rate, which is often higher than the preferential long-term rate. History of the capital gains tax. Since the early 1950s, the long-term capital gains rate has been lower than the top ordinary income tax rate. In 1997, the top rate was reduced from 28 to 20%. In 2003, this was further reduced to 15% under the Jobs Growth Tax Relief Reconciliation Act. The top rate increased to its current 20% in 2013 under President Obama. The Affordable Care Act added an extra 3.8% for the NIIT, Net Investment Income Tax, for taxpayers over certain income thresholds that became effective in 2013. What changes will Biden make to the capital gains tax? The Biden tax plan would raise the top marginal income tax rate to 39.6% from the current 37% level. For taxpayers with income above $1 million, the long-term capital gains rate would increase to 39.6% as well. When the NIIT is added in, this rate jumps to 43.4%. At this time, it appears that the Biden tax plan will leave the current capital gains tax rates for those at lower incomes as is. Another major change related to capital gains taxes proposed under the Biden tax plan is the elimination of the step-up in basis for inherited assets such as stocks, real estate, and some other types of assets. But that proposal is already hitting opposition from Democrats in Congress, who are said to be considering allowing beneficiaries to defer the tax bill as long as they hold the assets. How would Biden's capital gains tax affect the wealthy? The increased capital gains rate would reduce the amount of gains that a wealthy investor would be able to keep from selling an asset. Under the current rules, a $100,000 long-term capital gain would face a $23,800 tax bill at the federal level. With the proposed rates under the Biden tax plan, the taxes on this gain would jump to $43,400 for those above the income threshold. For a wealthy investor, realizing gains on several holdings during a year, the increase in capital gains taxes could be significant. Passage of the Biden tax plan is not a certainty. and even if it does pass, some sections may be altered. That said, there are some planning considerations for the wealthy if it does pass. For wealthy clients who are charitably inclined, an increase of this magnitude in the capital gains tax might be a good reason to donate some of their appreciated shares to charity. This offers the benefit of a charitable deduction for the market value of the donated shares. It also removes any taxation of capital gains. This can be a very efficient way to make charitable donations under the current rules and likely under the revised rules. How will Biden's capital gains tax changes affect ordinary Americans? On the surface, many non-millionaires might be saying to themselves, "Who cares? This doesn't affect me." However, ordinary Americans may still find themselves affected in a number of ways. First, if these rules are enacted, some experts say it could trigger a sell-off in the market. While this would likely be short-term in nature, the portfolios of most investors could take a hit, including those beautiful 401k plans and other investments. Owners of small to mid-sized businesses could also be affected. The impact could be twofold. First, small business owners who sell their businesses for a price that pushes their income for the year over the $1 million threshold could see any capital gains on the sale of the business taxed at the new higher rates. Second, if a business owner dies and wants to pass the business on to their heirs, the value of the transaction could exceed the threshold where the heirs would be eligible for a step-up in basis on the value of the business. Based on an Ernst & Young study, this could have a negative impact on the heirs, the business, and the economy as a whole, depending upon which version of the repeal of the step-up in basis is enacted. Another area where the proposed capital gains tax changes could affect ordinary Americans is when selling a home. For sellers of a primary residence, there is an exemption before any gains on the sale are taxed. $250K for an individual or $500K for a married couple. The rules state that the seller must have lived in the home for at least 2 of the 5 years prior to the sale to qualify for this exemption, though there are some exceptions to this rule. With home values skyrocketing in some markets, a home sale could bump some sellers over the $1 million income threshold for the year, even with the exemptions. This is especially true if the seller originally purchased a home during a down market, such as during the financial crisis of 2007-2008, when home values in many areas plummeted.